Good morning and welcome back to the latest edition of the InvestTalk market analysis for the week ending March 18th, 2023. I'm Justin Klein. Thank you all for tuning in and subscribing to this channel as well as our podcast, InvestTalk. Now this week I'm going to title the video Fed Action, Quells Market Fears for Now, but what's next? And that's what we're going to dig into. But as always, going to go into the economic data. Try to run through this real quick. But the Consumer Price Index, CPI index, came at year-over-year core at 5.53%, excuse me. But month over month, it was flat. Right. So what you can see here, and I've been saying this for the last few months, is look at these step change increases in inflation, end of 2020 and throughout 2021 and the early part of last year. But you can see really since June, these month over month increases have been pretty meager, and especially since September, right? And the last 2 months have really been a step change down. So there's a clear trend here. Inflation has peaked. And really, this is all base effects. And you see, that's why month after month, when you look at year over year numbers, it just continues to grind lower. And I expect by the back half of the year, this is going to be 1-2% because of what's happening in the broader economy, which is a weak broader economy. You have the New York Fed Business Leader Survey that came out at -10. It was just negative for, 6 months in a row. Okay. Now that's the New York region, but it's a pretty good indicator of what's going on in the real economy right now. The building permits month over month, that came up. That was a big reason, was likely the mortgage rates coming down in the month of February. So home builders, a lot of people are selling their home. Inventory remains low. So home builders are still looking to potentially build. They're able to buy down their mortgage rates for their buyers to 5% and still make a good profit on their homes. So not shocking to see the builders trying to build more. Now, export prices year over year in February, that was negative. Import prices were also negative, right? That's for the first time since 2020. Industrial production flat year over year, or month over month, excuse me. U.S. consumer sentiment also ticked down this month as well. So what you're seeing here is a real-time look at the economy that says inflation is not a problem if you're looking over a 6-month period versus a 12-month period. And the big question is, why look over 12? Why not? What about 18? What about 2 years, right? What about 6 months? So the real-time data here is saying inflation is dead for now. And I do expect it to come back eventually, but it's just telling, the signal to the Fed should be that the economy is slow, if not contracting slightly, and inflation is pretty much the same. And now you have a banking crisis, and now you're trying to raise rates again, and that's why the shifting in sentiment on the Fed rate hike next week kind of keeps vacillating. Earlier this week, it was up to 80% that it would be a pause. Now it's 62%. It's still going to be 25 basis points. A lot to figure out, especially over the weekend. You have Credit Suisse being purchased by UBS. So, the banking crisis is not fully behind us. They're still trying to figure it out. The balance sheet rose dramatically, basically reversing half of all the QT over the past year or so. And it's not shocking to see the market hold up a little bit, and that's what we're going to dig into right here. So let's look at the NYSE, and that was definitely weaker than the larger cap indexes, and a lot of that has to do is because small caps struggled. Here's the Russell 2000. Let's just go IWM. The IWM was weak on the week, right? Whereas the S&P bounced a little, and remember, the growth is outperforming right now because the Fed is pivoting, or looks to be pivoting, excuse me. So if you look at growth over value, growth is outperformed so far this year in expectation of the Fed pivoting. And what you see here is the 10-year. It's peaked in November. And so that's when value kind of had that pullback. The economy has gotten weaker, and a lot of the value sectors are in those more cyclical parts of the market. And you can see that with the energy space that sold off. But still, not anywhere, not a big issue here, right? Haven't broken any major support, still making a series of higher highs and higher lows. In fact, here, this is still a higher high, right? Barely, but it's a higher high. Now you have one lower high and one lower low. So it could be the start of something more broad-based, but you zoom out a little bit and you can see nothing wrong here, right? The 70 to the 2.5 retrace, just a nice little pullback as you would expect. And industrials also doing fine, right above the 50-week moving average. Pullback on pretty high volume, but nothing that worries me in my mind on the cyclical side. You have the banking index. That's really what dragged down the value side of the market. A lot of banks are in the value index. So it's not really the real economy. Is just more of the banking industry, which ultimately will feed into the real economy if banks stop lending. And I think that's the worry here, is that banks may stop lending as they're trying to kind of shore up their capital base and their balance sheets. So something to watch to see if those will be able to rebound, especially in light of the Credit Suisse news. Now the VIX is now in an uptrend, so this is something to watch. Is this going to consolidate, or is it going to reverse back lower? Really, all week you had a whipsaw in the VIX to see whether this was going to get a reversal or kind of continue higher. And what I'm watching are here the move index, and the move index is kind of like the VIX for the bond market. So when interest rate movements are big, this heads higher, and the market doesn't like that. You can see that here where this rallied for most of last year, and that was negative for the markets. And then once the market bottomed in October, this started to be in a downtrend. And I said behind the scenes that the Fed kind of pivoted and helped quell what was going on in that market. But now they're going to have to do that more distinctly, more outwardly, because of the headlines and the real problems that are in the banking sector. So, does this reverse is something I'm definitely watching. When this is above, kind of in the 150 range, plus it means the Fed is losing control of the treasury market and the bond market, so I'm watching for that to reverse. So those would be my big tells. The VIX reverse, does the move index reverse? Those are big tells for next week. Let's touch a bit on. Let's look at credit spreads. So these are short-term corporates to short-term government bonds. And what you see here is a rollover, not a complete breakdown, but certainly a rollover in weakness overall. We'll see if this kind of breaks to some new lows. I think that will be another indicator of whether or not the market's going to hold up or not. Okay. The dollar, another area watching. That one, try to get some weakness this week, and it did. A little bit of weakness. Positive, that would be positive for markets if this can roll over once again. This is kind of similar to that move index, right? When this is stronger, that is bad for markets. When this is weaker, that is good for markets overall. And we'll see what fall through we get next week. And the fall through that a weaker dollar had was in gold, right? Here's GDX having a nice day on Friday. Here's the GLD, that one really powering to new highs after a pullback. And, that's what I said on this pullback. I said, there's nothing wrong with this. This is a nice move higher and just a simple retrace to the 50-day moving or 100-day moving average almost. So you run a fib here. Right? This didn't even come close to the 50% retrace. So no problem here, and this should go to these highs. I don't see any reason why gold shouldn't go up there, especially with the backdrop of the economy and what the Fed is likely to do, which is the pivot. Let's see what else. There has been a bit of a flight to safety. Here's wide XLP, but not dramatically, right? So this is an uptrend. That means more money is flowing into the cyclical consumer parts of the market versus the consumer staples. And you had a bit of a pullback here, but this remains in a decent uptrend. So that's overall a positive. And then the FedEx news, they had earnings, beat expectations, raised guidance, etc. So that's certainly a positive for for the economy as a whole, that they have they're seeing at least some strength despite the other indicators that we talked about earlier in this video. ARC got a bit of a bounce. That continues to do okay, but still not a place that I would be allocating a lot of capital. Just a counter trend rally. In my mind, kind of like this here, right, from May to call it August, and then another rollover. I expect that probably later in the year. So that's about it. You know, it's a market that is still dealing with this banking crisis, and whether or not you get a rebound in the banking industry, whether they kind of quell those problems. So far they have. You know, their emergency lending window was open and it was used, and that's what the Fed's good at. Now, are they good at managing the economy? I would argue no, they're not. But I think it's pretty clear that they'll probably pivot here. They probably don't want to do it right away. They probably don't want to, be too reactionary and to the public. But ultimately, that's what they're going to have to do. They're going to have to pivot and really weaken that dollar, bring more liquidity in the system, probably lower interest rates or bring interest rates down by the end of the year, so that they will they can cure the balance sheets of the banks. Remember, in 2008, what QE was and what the TARP program was is to cure the balance sheets of the banks. And because the Fed needs the banks to lend. If banks stop lending, the economy grinds to a halt. So that's what happened in 2008. That's what the Fed was trying to resolve. And that's what they're trying to continue to do. They can't have everything collapse down to base money. They need the banks to lend, okay? And if their balance sheets are impaired, that suddenly makes them stop lending. And that is something the Fed doesn't want. So it's going to be a process, but I think it's pretty clear that the Fed is on the path to pivoting. And the 2 years now down below 4%, and usually they follow the 2-year Treasury. And so I expect them to, at worst, raise next week and then pause, and potentially they might be done. Right, they might be done with the rate hiking cycle, and then later in the year they start jawboning that they might cut, and then they cut later in the year. And I think that's probably the path which would be good for equity markets, good for asset markets in general. I thought that the first half of this year would be choppy, and it would to create a catalyst for the Fed to actually pivot. And I think that's what you're about to see. So. That's it for today. I appreciate you all tuning in. A reminder, the contents of the video are for educational purposes only. It should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a great weekend.